Hello and welcome to the latest Moneymakers Investment Trust podcast with me, Jonathan Davis. A reminder that for regulatory reasons, nothing you hear today, however stimulating and insightful, should be regarded as constituting individual investment advice or a specific stock recommendation. Them's the rules we have to work with. This week on the podcast, I thought it would be a good moment to revisit a conversation with Richard Pindar, who is the co-founder and CEO of Literacy Capital, a very interesting private equity vehicle that's been listed on the London market since 2021. It has performed very strongly since it joined the market, though it's had a more difficult period in the last 18 months or so. Market capitalization around 235 million as we speak. So, Richard, let's start off by saying this has been, I think, generally a difficult period for private equity generally, and yourself not excluded from that. I just ask a general impression, first of all, of how it looks to you from your end of the experience, comparing it to the much better years perhaps that we've had over the last 5 years. What's changed in the private equity market over the last 18 months or so?
Yeah, it's a good question, Jonathan. I would say there's probably two factors that have impacted private equity in the last 18 months, 24 months or so. I would say the volume of transactions, M&A transactions that have completed in the last 18 months has been at an all-time low, or certainly the lowest for the last 5 years plus, since before COVID's happened. And I think there's probably a few reasons for that. And then I would say there's definitely been some change in the UK market, sort of in the private sector. And I think there's quite a lot of evidence to support that now in terms of confidence, job creation, employment data, growth, etc. Since, it's probably a good time to be speaking since about 12 months ago in the run up to the last budget and subsequent to that budget. And I think, again, linked to the first point around M&A transactions, 24, as I mentioned, relatively low number of transactions completed. And then actually Q1 of this year was even lower than the figures reported in 2024, where there was obviously a change in president in the US in January, and there was some quite dramatic changes in policy, which then made it quite difficult for investors to feel confident about deploying large sums of money into new investments. So, the numbers of deals that then completed also then subsequently declined quite sharply. But kind of on a more positive note, I think as time has passed, perhaps investors have just got slightly more used to circumstances and kind of conditions. And so I think there are signs that investors are gaining a bit more confidence around investing, deploying money. And I think businesses are getting slightly more used to the conditions that they're facing.
I remember you were saying about a year ago in Q3 2024 that it was very unhelpful the way that the new Labour government came in and started effectively talking about the black hole in the government finances and creating a lot of uncertainty around what was going to happen in the budget, and that put a damper on confidence. And then, as you say, we had Trump coming in and huge amount of uncertainty there about the whole trading regime around the world. So that also had a damaging effect on confidence and activity, as you've said. And as yet, there doesn't appear to be any perhaps sign on either side of the Atlantic that we're going to get out of this cycle. You said things are slightly improving, but we have another run up to the budget now in the UK with a lot of talk about how much Rachel Reeves is going to increase taxes. And President Trump is still sort of yo-yoing around on tariffs. So on what basis do you say that you see some signs that things actually might be getting a little better? Let's start with the UK.
I think it's very fair observations. I guess we're almost getting to that point now again, given where we are in the year, where this time last year in the run up to the budget, there was, I think, quite a lot of fear. And then certain areas that people were concerned about, there wasn't quite the level of change that was potentially trailed or threatened in advance of the budget. So I guess let's hope that's similar this time round. But I guess fundamentally with private equity generally, and this counts in the UK as well, because of anywhere in Europe, there's far more private equity money raised and far more private equity professionals than anywhere else. And as a result, a lot of capital does get invested in the UK. There is still a need to invest. There's still a lot of dry powder and capital out there ready to invest. And so I guess from our perspective, we tend to look at opportunities that at the point we invest is too small and the opportunities or the businesses are not quite right for private equity. But we do work quite hard to get those businesses into a position where they are attractive to private equity. They are willing to invest in the businesses that we've got. And as a result, we do feel we've got many businesses that will be sought after, will be ready to be sold into the private equity market, where there still is quite a lot of capital available. So there is still demand and there is still capital available to invest in good quality businesses. And the deal we got done within the last month that was announced in relation to Velociti, where we managed to achieve a very good return, I guess is a good example of that. Despite the backdrop, despite the uncertainty, for good quality businesses, they will still gather a meaningful level of interest at sensible pricing.
But generally speaking, the private equity market, as you say, has been sort of gummed up effectively. They're not able to realize enough, and therefore people aren't prepared to invest as much new capital into the existing funds, and they're all under time pressure because they have, unlike you, it's fair to say, a time constraint in when they can realize the value about that. Well, before we drill down a little bit further to what you've been doing, perhaps you could just remind the listeners about what is different about the way that you do private equity as compared to the big other names that you're going to find, particularly in the investment trust sector, either the fund of funds or the direct investors, the very large private equity firms. What you do is different in a number of important respects.
Yeah, as you say, Jonathan, I mean, the private equity and particularly the listed private equity investment companies have done very well. Their record is good. They've typically outperformed other asset classes. But we do try quite deliberately to do different deals and help our portfolio companies in slightly different ways. The businesses that we invest in versus some of the bigger, more established players or more long-standing players, they do tend to invest in more well-established businesses, businesses that have been around longer, businesses that probably need a little less help and support in order to get themselves into well-run professional corporates, if I can kind of use that terminology. So many of the deals that we do, we are dealing with owner managers and founders of businesses. It is their baby. It is the first time they've ever sold a business. And as a result of that, the circumstances and the process involved is very different. It's less intermediated. The businesses are less well prepared. They're less ready. The owners might be less ready to sell. And so there's some of those factors that have to be taken into account into how we do things. And as a result of that as well, it's less around, I guess, stock picking in terms of just finding good businesses, successful businesses that will continue on a similar path. We do have to find businesses that we feel potentially with some fresh energy and some new ideas will be able to do things that they've not historically been able to do under their own steam. And so part of that, again, is around succession to founders that might often be wanting to retire. And so there is an element of risk around replacing founders and the knowledge that they've got and bringing in new people. We're more willing to do that than many larger or more established private equity investors. So it's marrying up both the businesses, but also the people side that will enable the businesses to flourish. But then as a result of that, it's taking into account a lot of the stresses and the emotions that might factor into decisions that vendors are having to consider. So yeah, the offering is quite different. The fact that we're a listed fund actually in many cases is quite helpful. Many of the funds of funds will end up having, again, slightly different alignment of interests to what we've got. I would suspect within many of the listed private equity funds, the manager's shareholding is significantly higher. And so there is a degree of alignment that brings as a result, and is an unusual feature where effectively the manager is also investing its own capital. So I guess where there have been criticisms in the past of private equity, potentially it's short-termism or the lack of alignment, we've tried to address with our structure, and we've continued to do so. And I guess the final point again is the charitable mission, which is still a significant part of what we do. We've now given away £12 million to charity, which is unique within the private equity industry as far as I'm aware. So again, many of the founders we deal with really value that. They really like that. They really like being able to talk about that to employees that they've worked with for a long period of time. So yeah, I guess as far as we can, we've tried to make our model as attractive and palatable to the vendors that we buy from, and take account of any shortcomings that might exist within the private equity model, albeit the private equity model has worked very successfully for decades now and has outperformed many of the returns in public markets. So we're generally bullish on the sector, but we've just tried to amend it and adapt it to make it even better.
Yes, and of course your structure, you say, is very different. You and your father, who's the chairman of the company, has significant shareholding in the investment trust. You don't charge a performance fee. You don't have any carried interest and so on. So it's a completely different structure that is designed, I think, to try and align yourself more closely with the interests of the shareholders that perhaps you sometimes see in the larger private equity funds and firms. So there was no growth in NAV last year, and you've just reported your interims for the first 6 months of this year, and you have shown a positive 5% or so gain over that period. But the market has basically re-rated you since last year. The first few years of your time as a listed company, you traded at a very healthy premium, but that's no longer the case, and your discount has widened, and it's out now in around 25%, which is more in line with the larger firms. Before we come on to what you might be able to do about it, why do you think that's happened?
There's probably a few factors, and it's hard to put your finger on any single thing. I think the topic of, discounts in investment trusts gets talked about a lot. But I mean, if you go back, as you alluded to 21, 22, 23, during that period, out of 400 or so listed investment companies, I think over that period, our investment performance was the best of any investment company. And as a result of very strong NAV performance and also multiple strong exits at significant premiums to NAV, as you mentioned, we were trading on a premium for a period of time, often quite a substantial one. As you say, NAV in 2024 was broadly flat. I think it was down about 0.5%. The NAV performance this year has been a bit better, so up about 5.5% so far in the first 6 months of this year. I think the focus for us, I guess there's a few things that we're trying to do to kind of lead on to the next part of your question as to why it's happened and what you can do about it. But I think better NAV performance would help that. More exits, as we've kind of touched on, would be helpful. And I think, again, private equity NAV performance for the last 18 months has been relatively muted compared to previous periods. And part of that can be attributed to fewer exits because there tend to be quite significant premiums evidenced by many, many years now of track record from private equity. There do tend to be premiums realized on exits. So if you don't have exits, there don't tend to be the NAV uplifts that investors want to see. And actually, again, we do report some portfolio highlights on a quarterly or annual basis as to what's going on. The underlying trading performance of some portfolio companies has not been as fabulous as it was in previous periods, which again, we've kind of touched on with what's happening in the private sector across the UK. And many companies having to adapt and cut their cloth accordingly. For the first, our profit growth year on year has been very good, but our profit growth has been greater than sales growth, which for us is quite unusual. And again, what has driven that can be seen in terms of overall headcount numbers, which unusually for us are down year on year. So I think there's a variety of things that we can do about it. Fundamentally, trading performance of portfolio companies needs to be good. We need to have exits of portfolio companies. As I've touched on, we delivered 15 times our money at a 52% premium on the sale of Velociti about 3-4 weeks ago. If we can repeat that, then I think that would help to improve the share price performance and rating. And then equally, just to do more marketing of literacy, who we are, what we do, how we're different. Because, when we listed back in 2021, unusually we didn't raise any money. And we didn't raise any money because as shareholders, we didn't want to. We didn't think it was the best things to do for investors. But as a result of that, we were relatively unknown in terms of awareness. As we came to the market, we didn't go out and speak to loads of institutional investors. And so we need to do more of that, and we are doing more of that. And actually, if you look at some of the share price decline recently, it has been on very, very, very small volumes. And it's been in August when increasingly people seem to spend more and more of it away from work. And so, there's just more effort needed. And ultimately, we need to have better performance, which, as you say, has in recent periods been more in line with the rest of the market.
By looking through your reports, your interims and your annual results, it's clear that you haven't been immune from the issue of not having as much cash coming in as you have had in previous years. And you've got around that by a number of means. You've actually, I think, extended your borrowings a little bit to bring more cash in. So you're feeling some of the pressures that the other private equity firms are feeling as well. I wanted to ask you about that Velociti deal. So what exactly happened there? So you basically sold an interest in this company, which you've been helping for a period, but you haven't sold your whole interest. And then you sold it to another private equity firm, and then you bought some of it back again. How does that actually work?
So we did the original deal in Velociti back in February 2020, so just before COVID. The business at that point was called EPM. It was a small business that we bought from an individual in his 70s, focused on selling consulting services and software services into the bus market. We built that business out with 3 other acquisitions, expanding the business that was solely focused on the bus market into rail as well. So it was a sort of diversified business. We had to, over a period of time, make some changes to the management team, and we were a majority shareholder in the business, a significant majority shareholder. And so we could do that. We had the influence that we needed to be able to make those changes. And I mean, if you look back over the last 3 or 4 quarters, Velocity's performed really strongly for us. We also last year brought in new leadership into the business, a new CEO, a new CFO, and made a variety of other changes to the group, which made it very attractive to private equity. And so I guess effectively the deal that we did with the incoming investor, who the new investor is a minority investor in Velocity. Literacy now is also a minority investor alongside the incoming investor. And effectively the amount of the company that we previously owned, more or less, that is the stake that in aggregate we own with the new investor alongside us. So management are still significant shareholders. We obviously then effectively exchange some of our equity in Velocity for cash and equity in the new business going forward. So I guess it shows that we've managed to create significant value in the business. Somebody's been prepared to pay a much higher price than we paid and the amount of capital that we invested. But equally, we feel very positive about the momentum in the business and the future potential for additional value creation, which is why we've kept a significant stake in the business. But equally, we wanted to bring a good partner on board. We wanted to bring the right partner on board. Their track record for businesses of this type, shape and size is extremely good. They're an investor I've known for a long period of time. And so, yeah, we're really optimistic about the future prospects for Velocity. And as a result, we thought it's worth taking some cash off the table to rebalance the portfolio, to invest it into new things, to demonstrate exit, to pay down the borrowings that you mentioned. But equally, it wasn't a business that we were ready or prepared to exit in full. We could have done, but it's just not something we wanted to do at this point.
Right, but it is the case that the amount of money you're putting back in again is less than the amount that you've taken out.
Correct.
It's not just a case of sort of shuffling the pack, if you know, which we know has happened in some cases with private equity.
Yeah, I mean, our total return on the transaction was just under 15 times money, and more than 50% of that we've taken out in cash. So we've taken out significantly more than the amount that we originally invested into the business.
But would you have done that if you hadn't had these sort of cash flow pressures, or was it just part of a normal process?
It's a good question. I think we would have done, albeit, again, as I mentioned, it wasn't a business we were desperate to sell. But the reason we sold it or we transacted on that business also was the keenness of management to sell and to realize some value for the value that they had created. So we're very receptive, and rather than being overly fixated on what suits us, we're also quite amenable and we are receptive, and we do listen to what management also want to do. And, you know, the management team there have done a fantastic job for us. It would be slightly unfair and disrespectful for us to dig our heels in and say, no, we'd like you to do another 12 or 18 months when we know we'll get a higher price. By keeping a stake in the business, it helps to mitigate the fact that we know in 12 or 18 months' time the business will be worth more. But equally, you can't hold out for more indefinitely because you don't know what might come around the corner. But yeah, we're very happy with the outcome. I mean, it's hard not to be. The management team are very happy. I think the new investor will help us to add more value to the business. But equally, it would have been nice to have had another exit or two thus far this year. But again, as I mentioned, what's happened so far politically, globally, has made that quite difficult. So you kind of have to adapt and take into account what you can control. But yeah, overall, it's been a really good transaction. And, 5.5 years to make a 70% IRR, can't really complain.
You are listening to our Moneymakers podcast. We are an independent research and publishing venture, and grateful to JP Morgan Asset Management for their generous no-strings financial support, which enables us to keep the podcast free and our editorial principles intact. Each podcast episode goes live shortly after being recorded, with a weekly catch-up email notification every Saturday afternoon. Why not also try our premium weekly subscription Moneymakers newsletter, which provides a comprehensive summary of all the latest news, results and performance data from the investment trust sector, with links to the relevant stock exchange announcements if you want to go down that rabbit hole, and many other regular features including more than 170 in-depth and independent trust profiles, regular market commentary and videos, plus the editor's list of favourite funds. If you never want to miss a thing that might affect your portfolio, do please sign up today at money-makers.co. And if you follow this podcast on YouTube, please do use the subscribe and like buttons. Thank you. Well, you have said in your last announcement, I think, that you were going to be rebalancing towards existing investments. Now, what does that mean? In other words, you're not going to be going out looking for a lot of new things. You're going to be putting more money, or at least holding the fort, if you like, while putting the effort into the 20 or so companies you actually have at the moment. Is that right?
Yeah, I think it helps partially explain how labour intensive some of the activities we do are. It's quite hard to make 10 or 15 or 20 times your money by doing nothing, unfortunately. And so a lot of the businesses, as I've alluded to, they do need some help. They do need effort. They do need brain power to try to turn them into businesses and assets that will be highly sought after and highly valued. And we do have lots of potential within the portfolio. Velociti 15 months ago was not a top 10 holding. We knew there was loads of potential there. We knew it was not being maximised. And the changes we made in 24 delivered that in spades. And we realised that there are opportunities to do more of that. And so rather than do loads more deals and spread ourselves more thinly, we would like to take our time, because in the last 15 months, we've done 5 new deals, which for us is a relatively large number. And so rather than run headlong into doing more deals, we do want to be increasingly selective about the situations that we inherit, the sectors we invest in, particularly given some of the challenges certain sectors are seeing, to make sure we avoid making mistakes. And actually, in the last 15 months, I'm really pleased with the quality and the caliber of the investments we've made and the momentum that those businesses are showing. And equally, given everything that's going on in the world at the moment, and also the track record that we've got as an investor, we can afford to be increasingly picky. We are shown a lot of investment opportunities, a lot of vendors, because they will keep residual stakes in businesses. They do want a partner that does have a good track record in helping these businesses to grow. And so we don't want to be busy fools. We want to do a smaller number of things really, really well. And particularly given exits have been harder to come by, we just want to make sure we're spending our time well.
And this, of course, is also behind the fact that the board has just agreed to increase the management fee, I think from 0.9 to 1.5%. That, I think, you justified on the grounds of as you get bigger, you need more resources. Is there a danger that will kind of undermine one of your key selling points, that you're a very competitive vehicle compared to some others?
I guess if you look at the cost of private equity that is available elsewhere, 1.5% is still very competitive. You know, the normal charging structure is colloquially known as 2 and 20, so 2% management fee and 20% carry. So 1.5% is still lower, and we charge no carry, so still very low. And also, if you look at many of the other listed investment companies, in reality, they are funds of funds. So the management fee is the management fee, but then they are also paying 2 and 20 on their underlying fund interests. I think our fund interests now are 4 or 5% of NAV, and actually most of those we don't pay fees or carry on due to relationships that we've got. So there's no sort of doubling up or layers of fees in our structure. So yeah, we're still very confident that we can offer very good value in, I guess, nominal terms, in terms of the actual amounts of pounds being paid by shareholders in fees. But also, we did allude to last year when we made the change, and I've kind of alluded to it in this conversation, just around how labour intensive the activity is in helping smaller businesses and the number of businesses we've now got. You know, there were some changes needed to sort of make sure that we do maximise the potential in the portfolio, changes in terms of personnel and increasing the size of the team at this end. So yeah, I think the cost to shareholders is very fair and is still low relative to alternatives. And I think it just reflects the amount of effort that needs to go in, and as a result, the cost associated with some of those initiatives. And also in part of the kind of 60 basis point increase in management fee, there was a slight reduction in the charitable donation, so that the overall impact on shareholders was much more modest. So the overall cost of those two expenses went from 1.8% to 2%. So again, we were conscious of cost on fund. But as you say, we in the board felt that it was something that was necessary in order to ultimately get the best NAV performance for shareholders, which is in everyone's interests.
In the recent statements from the board and yourselves, obviously, since you and your father are on the board, you're talking about the first return of capital by the end of 2025. Now, what's the thinking behind that? And are you able to say what kind of form that might take at this point?
Yeah, it's a good question. So I think it was last May we announced a B share scheme. And so we had already put in place the mechanics or the plumbing needed in order to return capital to shareholders in a sensible and efficient way. So that authorization was kind of renewed at the most recent AGM from sort of 3 months ago in May 2025. So any return of capital is most likely to come through. It's akin to a special dividend. So, a one-off return of capital, but the B share scheme means that the cash that's returned to shareholders is treated as a return of capital, which for a large proportion of Literacy Capital shareholders who are individual holders rather than corporate or institutional holders means they get a lower rate of tax on that cash that's returned to them. Our preference would be to treat all shareholders the same, so everyone gets a pari passu treatment or sort of return of cash rather than buying back shares, albeit we have said we do have that in our arsenal if we need to do so. So I think that will be the mechanism. I think, again, the reason for it is, I guess it's a variety of factors really, but it's primarily to demonstrate to the market and to shareholders that we are focused on, I guess, shareholder return, doing the right thing for shareholders. We don't want to grow NAV or AUM in, I guess, the usual or traditional way to generate fees for the manager, which would often be the financial incentive that the manager has. We do have alignment with the shareholders, and one way of achieving that is to return cash to them. So yeah, we've been going now nearly 7 years. It will be the first return of capital. And as and when we do have most likely exits or disposals of assets on a case by case basis, if we feel that that's a sensible use of capital, again, rather than being fixed to frequent dividends and then having to factor that in and marrying that up with potentially lumpy inflows, given the nature of the asset base that we've got, we felt doing it on an ad hoc basis following the return of some capital or cash inflows is the most prudent and the most sensible way of returning cash to shareholders without putting the balance sheet under any pressure. So as we've already announced, that's our intention to complete that before the end of this calendar year.
Right. You mentioned that says tax advantages in certain cases. Obviously, there are some quite significant capital gains made by some shareholders due to your good performance recently. But who knows what the Chancellor might get up to in the budget? There could be another change of regime, of course. And then you might have to think again, I suppose, if the rules change. So, next question, just going back to the portfolio. You've talked about what you've done with Velociti, and that obviously was marked up in the latest figures. Most of the other significant holdings, you have 20 and are very concentrated in the top 10, weren't sort of marked up at all, I don't think. And you've had two problem children. What is the latest on those? Perhaps you could just remind us those two businesses and why they have run into some difficulties in the last year or so, and are they on the mend? I think one of them you're saying is improving and the other one is still perhaps in special measures, but I may have got that wrong.
Yeah, as you say, Velocity was a very, very strong performer. And then most of that gain was realized on the transaction. So that's obviously been a success. The other top four holdings were held relatively flat or registered modest or small declines in the first 6 months of this year. But again, I think that's just a prudent reflection of trading and what we think those businesses are worth. I think the fact that we've realized quite significant premiums on all of the transactions help to demonstrate that we've been quite prudent in not prematurely realizing uplifts or gains. And as you mentioned in your question, we have had a couple of businesses that were relatively large, if you go back sort of 18 months, 2 years, that performed spectacularly well, if I'm honest, coming out of COVID. They were the two biggest contributors in 2021 when we generated nearly 100% NAV uplift. And effectively in 2024, some of that growth unwound. It was ultimately not sustainable, but the two businesses are still significantly larger than they were at the point we invested. And Literacy Capital has still made quite significant profits on paper, albeit not as significant as they were 2 or 3 years ago. I'm pleased to say, neither business is seeing the same headwinds that they were seeing if you go back 18 months or so. And I would say particularly TechPoint is showing some really good signs. They move, it's probably this week actually, into a brand new facility, which will be cutting edge in its sector and have really, really impressive capability. So that's a very exciting milestone for the business. And that's happening as we speak. They're probably moving into the factory this week. And that will bring some tremendous advantages to TechPoint. And we would hope that that will translate into improved trading performance. And then subsequent to that, some NAV uplifts sort of generated by that company into 2026. So, yeah, I would say neither of those businesses today are problem children, to use your terminology. They've obviously had stickier periods of trading, but ultimately they're both significantly larger and more valuable than they were at the point we invested. It's just unfortunate that sometimes the trading performance is not linear, doesn't go in a straight line, but we've just had to adapt and make changes to take account of the circumstances of different portfolio companies that we're seeing.
Right, so notwithstanding all that, you have been able to make a couple of new investments. Perhaps you could very briefly just tell us what they are and what are your hopes for them?
The two new investments we've completed this year, it helps to demonstrate the breadth of businesses that we look at. So one manufactures sausages and the other is a software business focused on businesses that work with financial trading platforms or energy platforms, which again, you might sort of query, well, what's the consistency there? Both businesses were 50% owned by two founders. Both sets of founders realized that for different reasons, they wanted to bring on board a partner to help them take the business on for a bit of a fresh lease of life. And in both businesses, we had effectively chairs that we wanted to work with or people we'd identified that could help us take those businesses on a journey of growth for the next 3, 4, 5 years. And both of those individuals that were going to help us lead and create a management solution in those businesses had very relevant experience and had grown and run much bigger businesses in the relevant sectors. I'm pleased to say, both of those businesses, we're really pleased with early signs. Both are trading nicely. And I think both are very well set for 2026. And again, quite deliberately, given, as you mentioned, the amount of borrowings that the fund had at that point, we thought long and hard as to whether these were transactions we wanted to proceed with. But if I'm honest, our level of conviction on the future performance and what we thought those businesses could do for us in terms of both short and long-term NAV performance, we felt they were deals we had to do. And again, we used our RCF and briefly drew money on the RCF, which was subsequently repaid once Velociti was done, in order to fund those new deals. But yeah, both doing really nicely, very different. But again, just a bit of background to help show some of our thinking and actually the similarities in the circumstances of both of those businesses.
So coming back to the bigger picture then, which is the UK, you invest mainly in UK-based companies. You have obviously global exposure, but UK-based. A lot of them are sort of people businesses or software businesses and so on. What is your feeling about the UK as an economy at the moment? You mentioned obviously the damage that was done last year by the national insurance increases and so on, things like that. Do you see any reason to be gloomy about this sector of the UK economy, shall I put it that way?
I could talk for a while, I suspect, on this. So I'll try and keep it brief and succinct. But I guess we're quite fortunate that the businesses we have significant stakes. We have very good relations with the members of management, and we do have the ability, and they have the ability to pull levers to make necessary changes to adapt to whatever circumstances and whatever hands that we're dealt. And I would say a general point would be the private sector is very adaptable. It is very resourceful. And in all parts of the world, the private sector finds a way to thrive. And so I think generally we kind of have to be optimistic and we have to be opportunistic and we have to be able to be agile and adapt to whatever opportunities are out there. And we have to mitigate whatever challenges or threats there are. That being said, it's probably been the hardest period for a long time for private enterprise in the UK. You look at headline numbers, you look at whatever survey data you want to, none of it at the moment, I would say, is particularly strong or bullish. That being said, it doesn't mean you can't flourish, grow, succeed within those constraints, but it just does make growth and success a little bit harder, and it does require a little bit more patience, which again, with the structure we've got, we are allowed and we are able to have, with a closed-end structure with unlimited life on our funds. We're not banging on the manager's doors saying, we need to sell these businesses, we need to wind the fund up. We have a bit more flexibility, patience, adaptability than traditional private equity can have. But equally, I think there are some sectors that are finding things much tougher, where tax changes have happened. That impacts certain businesses, certain sectors more than others. Consumer confidence isn't brilliant. Consumer spending isn't particularly high. Many of our businesses, or the vast majority of our portfolio, is focused on B2B customers, higher margin businesses. We do tend to focus on businesses where they're not huge employers, or they're not hugely reliant on low-cost labour, which is where there has been significant inflation, when there's been minimum wage increases, there's been national insurance increases. So it does factor into your thinking about, well, what are the new investments do we want to bring into the stable? But equally, we do have the ability to react quite quickly to whatever is happening. And it's not as though we've got 20 public or listed companies in the portfolio and we just have to sit there passively and kind of wait and watch. We are more involved and we are more interventionist when we need to be. So yeah, by and large, as has been seen at a macro level, it's not been especially easy. And I would say, despite the relative doom and gloom in the UK, employer or payroll costs in the UK relative to other European countries are still relatively low. We do tend to become slightly insular and focused on the UK only, but actually, you look at France politically, you look at Germany, there are lots of challenges across Europe and the US and elsewhere. So sometimes you kind of have to have a slightly broader perspective. And I think all things considered, things could be a whole lot worse and things could be a lot more difficult.
I brought that up partly because in the latest interest statement, I think your father sort of unleashed a comment as chairman about tax policy. If there's more tax rises, given how much the government fiscal issues are at the moment, would be unsustainable and fruitless. Is that his own personal hobby horse, or is that something that's shared across the business, shall we say?
I think he's had a career probably for 30, 35 years around efficiency in private and public sector. So he's probably got his own views on some of that stuff, but without being excessively political, there's a variety of objectives, I think, that the government has got around creating employment, creating opportunities, keeping inflation low. And I think some of the tax rises that took place last year cut across quite a few of those. I mean, the employment data has been negative for 10 successive months. The changes in NI and the changes in a variety of things have caused inflation. It's impossible to say otherwise. So it would be helpful to have a period of stability and, I guess, decisions that are taken that meet all objectives, rather than having a variety of things that take place that then counteract other broader objectives. But again, as I mentioned, we just have to deal with the rules that are imposed from above and make the most of the circumstances that we see.
So my final question, I guess, is this. You've obviously been listed for about 4 years now. How would you sum up what your proposition is if someone is considering they want to put some money into the UK market compared to the other options that are out there? So I guess it'd be more realistic to compare you to small cap trusts, or even at the lower stages to venture capital, which obviously has been going through an even tougher time, or the traditional private equity funds. Where do you kind of sit in that spectrum, and what would you say marks you out from the rest of the opportunities out there?
Yeah, it's a good question. I mean, we are in many ways quite unique. I don't think there's any trust that ticks all of the unusual characteristics that we've got. I think there are obvious advantages to investing into private businesses. You get more information, you have more influence, more control, more information at your fingertips, and you can make changes. So I think that's a positive for private markets over public. I think the smaller end of the market, there are more opportunities to invest in businesses far more cheaply. Many of the private equity players are more focused, as I mentioned before, on more established businesses. They tend to pay much higher prices for more fully formed businesses than we would ever do. There's a pyramid, I would say, of businesses in terms of at the bottom end, there's a huge number of small businesses. And as businesses scale, there's just fewer of them. But actually, the private equity interest in businesses is inverse to that, or certainly is much larger on sort of medium-sized businesses than smaller businesses. So as a result, that plays to price, it impacts deal structure. So yeah, I guess if you look at the alternatives at the moment, particularly as the US market particularly on the technology side, and NASDAQ or even S&P is very expensive. The UK still reasonably stable relative to other geographies. There are obvious challenges. The VC market that you touch on has seen some significant challenges. Quite deliberately, we do now exclusively focus on profitable cash generative businesses as opposed to earlier stage VC type deals, because our experience shows they do require a lot of help. If our businesses have a bad quarter or a bad year, it just means they make less profit and less cash, which is a lot less bothersome than a business that is reliant on raising more money for its survival. So I think over time, we've become more focused on what we do want to do or what we don't want to do. I think we've found a cohort or types of deals that we feel very comfortable with, where we're comfortable we're not overpaying. We're comfortable that we can inject the change that's needed to generate the types of returns that we have done on several occasions now. And it's just, I guess, sticking to our knitting of finding fundamentally solid, relatively boring businesses, but then getting them into a position where they become highly sought after and very valuable to other investors or acquirers. So I would say that is, in a nutshell, what we're seeking to do. And if we can continue to do that, we should generate very strong returns for shareholders.
But in the meantime, you've had to live with this discount volatility, and it'll be interesting to see what steps you can take to try and bring that discount back in again, which I think is your objective. You're not going to just sit there like some of the private equity funds have done for year after year after year with the shares at a significant discount.
Yeah, exactly. I mean, unusually or unlike some of the other funds that have had a persistent discount, we are significant shareholders. It doesn't suit us. We don't want to be in that position. But equally, we're not going to do something short term or in reaction to a discount that has been pretty short-lived. Ultimately, our objective is to do the right thing that creates NAV growth. And we do think if we can generate really strong NAV growth in a controlled way, then that will get interest and awareness and be rewarded by the market. But equally, if the market doesn't reward that, then we can take more action to make sure that that discount does close. But this is not a short-term game, it's a long-term game. So as you say, there will always be some volatility, particularly given what we've seen with low volumes in August and some of the unexpected things and curveballs that have happened over the last 12 months. But yeah, we're not thinking about this over the next few weeks or months. It's a longer-term venture than that.
Very good. So that was Richard Pindar, who's the CEO of Literacy Capital, the interesting private equity vehicle that's been listed in London since 2021.
Thank you for listening. The Moneymakers Investment Trust podcast is independently produced and edited and is freely available on YouTube, Apple Podcasts, Spotify, and other podcast channels. You can also sign up at money-makers.co to be notified of each new edition. If you want more news, analysis, interviews, and other investment trust content, don't forget to look at the Moneymakers Circle, available for a modest subscription at the website.